Hey everyone, thanks for joining. Fortunately, we forgot to hit record on this webinar until about 30 or 40 seconds in. So we're about to merge this into the webinar, but just so you know, we missed the intro. So we're doing this webinar along with Miguel Ocio Brillenberg of Guardia. We're super stoked to have him on, and we hope you enjoy.
So without further ado, let's kick it off, John. Let's see that first slide.
Yeah, so this slide, this chart's really, honestly, I think the whole inspiration or a lot of the inspiration behind why we do what we do. So kind of on the topic of how institutions allocate capital, what this chart is showing is it's showing the allocation to alternatives and then other sources of investments across different investor classes. And so the red bars are showing allocations to alternatives. So things like infrastructure, private equity, hedge funds, et cetera. And what we noticed, which is really interesting, is that you really don't start to see meaningful allocations to these markets until you get into, ultra high net worth individuals who, $30 million or more. And then once you get into institutions. And what was really interesting is that these institutions who have, entire teams focused on thinking about how they deploy capital, how they invest in where, they're all allocating, call it, 10 to 20% to alternatives. And there's a lot of different reasons for that we'll dive into. I mean, and we'll dive deeply into this. One of the reasons is liquidity. A lot of these assets are illiquid. And so, even though historically they perform quite well, there's a reason why they don't invest 100% into these assets, right? And it's important to have a diversified portfolio. But some of the other things are just around access. A lot of people are kind of barred out from accessing some of these opportunities until you get into that, 30 million net worth range or become an institution. But one other thing that is really powerful about this is we all know that diversification is just hugely beneficial, and so any type of alternatives that somebody in like the mass affluent or that high net worth individual range adds to their portfolio is immediately adding diversity to their portfolio, and that can be extremely powerful. And so it kind of always bugged us, right, looking at a chart like this, seeing that these institutions are getting access to these sorts of opportunities and most other people are not. And I think this follow-up slide, which we've actually showed in a previous webinar before, but I love it, kind of highlights that. So what this is showing, this chart looks really complicated at first, but basically what it's showing here is your risk return profile, right? So if you have volatility or risk on the x-axis and then your return on the y-axis, what it's showing is this gray line is kind of what your risk return profile looks like if you're invested in what's called traditional asset classes. So these dark blue dots of kind of, stocks, investment grade bonds, treasuries. If you have a portfolio like that, you can kind of, according to Fidelity and data that they looked at over the last 20 years, you can move your risk return profile across this gray line. But once you start adding alternative asset categories, so things like buyout, venture capital, private real estate, distressed debt, and things like that, just instantly adding that level of diversity, you're actually able to move your investing frontier from that gray line to that green line. And that's why a lot of these institutions are making these investments, right? That added level of diversity allows you, for what's really powerful is for the same level of risk, you're able to get a higher level of return. And that sort of diversification and the stability that provides is really powerful to these institutions. And that's why at the end of the day, or one of the key reasons why at the end of the day, they make these investments. Yeah, I don't know if you have anything to add to that, maybe on this slide.
Yeah, no, I mean, two things I wanted to add, like why do these institutions have the capacity to do this versus others? And I wanted to highlight knowledge as one of them, right? It's like the understanding of this asset class, but also the clarity on how they need to deliver over time, especially if we think about like pension funds, right? They know that they have to pay out X amount over time. So they have a little bit of an added benefit where like their mandates, so the rules they have to follow to cater to their investors are crystal clear. Whereas an individual or a family, it's not crystal clear. And so if these people are using alternatives in private equity to diversify, right, to be able to sort of either get paid more for taking the same amount of risk they may be taking in private markets, or stomach more volatility on the back end. So if they're doing this and they have a lot more clarity, individuals and families, if and when they have the ability to add this into their asset mix, stand to benefit quite well. It's obviously very case by case, right? Like if you're a big real estate investor and most of your net worth is in real estate, there's other things to consider. But I was thinking earlier today, like if you were 20 years old and you had the capacity to put into alternative assets, while your income is steady, while your other piece of the portfolio is steady, that excess return over time is pretty sweet to think about, especially if it comes from diversifying out. And a lot of the people I talk to are like, "Oh, I'm diversified. I own the S&P 500." And immediately it's like, well, no, all your risk is US related and it's all public stock related. So in reality, you're quite concentrated, when we get to those scenarios where people are looking for their diversification benefits, and you can push their portfolio through like a 2008 financial crisis scenario or a Asia crisis scenario, and then they start to sort of see it pretty quickly. But I'll move on to this slide, how institutional investors allocate, and it ties to slide one, but we drill down a little bit more. So we see that their biggest allocations are fixed income and public equities. We see endowments in particular, they have a little bit more risk appetite than a corporate TV plan. They've got 35% in equities, and about 9% in fixed income, which that's also an interesting dynamic to look at, John, because everyone always loves to talk about the 60-40 portfolio, or flip that as well, like a fixed income heavy portfolio. And we see here that endowments have a lot more appetite for risk than corporate DB plans. You see that in the fixed income allocation, right? They're only looking at 9% versus 49%. And then we go down to private equity and you see that endowments have quite a large allocation. I mean, 12.3%. It's meaningful to them. And if we were to sort of compare that to fixed income, that's a story that we can tell over the last 20 years for institutional investors. Like I mentioned at the beginning of my soliloquy here, was, before zero interest rates, you had institutions that were heavily into fixed income because there were spreads. You could find some premium there. You could control your risk a bit better. It's a lower volatility asset class. But when interest rates went to zero, these institutional investors had these mandates. Like they have to keep up with their pension payouts or their insurance customers, premiums and whatnot. So they're kind of looking at their old playbook and they're like, fixed income isn't working anymore. We need to find a way to not take all of that allocation and put it into risky public equities and figure out how to generate yield. And what we've seen, especially in the past few years, has been this, throughout that whole era, an explosion in funds for capital flowing to private equity, and also an explosion in valuations because there's been so much cash chasing deals for such a long time. And today, now we're seeing the flip of that. We're seeing interest rates going up significantly, fixed income becoming more attractive. But now you're seeing that a little bit of euphoria building up in private credit. So it's almost like we crossed the Rubicon, over the last decade, and institutions have learned we don't need so much fixed income. Let's make alts a key part of this. And now that interest rates are coming back up, they're revisiting that. So yeah, some of the takeaways, 20% is allocation into alts. If we extract even, private equity and we add on real estate and other alts. So that's pretty big. That ties pretty well with that first slide. And even with real rates, like I mentioned, real rates are above zero. but there's still a desire to allocate to this asset class because it's served these multi-asset portfolios well. And then, tailwinds, the search for risk adjusted returns with rising rates. I don't think alternatives are gone because rates are going up. I think it's a new normal. It's a new normal to have it as a important part of the portfolio, and kind of sweetens things now that you have treasuries at 5%. So I'm really interested to see what plays out over the next 5 years or so.
Miguel, I'm very curious your point of view around, this chart is obviously all about kind of how like institutions allocate.
Yeah.
You spend a lot of your time thinking about individuals and helping them think through their finances. What are what's like the takeaway that you draw from this chart in terms of like learnings that you think we can take from how institutions are thinking about allocating capital?
Well, I think, the first thing is these guys are smarter than me, right? They have a lot more firepower, CFAs, PhDs looking at their asset allocation, and they're making decisions to allocate to PE, anywhere from, let's call it 5% for those corporate plans, 5 to 20% in some cases. And, especially when it comes to investment to security selection or manager selection, the little guy can often benefit a lot by looking at what the bigger, smarter guys are doing. I think the main difference here between just saying, "Oh, I'm going to copy what said pension fund does or said sovereign wealth fund does," when it gets to individuals, it gets complicated because you have to understand what are your liquidity needs and what is your sort of risk tolerance. Those are the two things that are extremely personal, because institutions, like I mentioned before, have the luxury of sort of frameworks and mandates. Like, no one is emotionally, unless they're at that very senior PM level or a key decision maker. No one is like emotionally selling anything because it's down 10% in a day. So basically, like, I think great tool, like great to watch what institutions are using, look at their risk adjusted returns, look at how their multi-asset portfolios have done. Take away that they're great allocators, they're diversifying across asset classes, and then layer that across what's my risk tolerance, what are my liquidity needs. Because especially if we're talking private equity, it carries a premium. I mean, it carries a premium to public equity because there's extra work involved, there's extra skill involved, there's key experience involved. So like I said before as well, like, if you can allocate to an alternative asset class early in your investment journey without it hurting you, I think it makes for an incredible opportunity, from like a technology standpoint, from a timing standpoint. I mean, this wasn't really possible 10 years ago or more, unless you had those 30 mil in the bank or 10 mil in the bank. I think in the last 10 years we've seen the ability for these funds to take in people with even like the 1 to 5 million, but up until recently that hasn't really been possible. So me, I'm an asset allocation obsessive. Like, that's what I like to spend my days thinking about, that very top level view. So it's fantastic. I mean, it's a great way to diversify out, taking into account liquidity and maybe what your expectations are for the near term. And in my camp, I almost feel like the lockups help, right? Because it keeps you from making impulsive emotional decisions.
Awesome. Yeah, and then I think in terms of it's very interesting in terms of like the lockup. So we can kind of get into it in a second, but in many ways, that illiquidity premium that people get can be really helpful. And I think we should dive into the pros and cons of that in a second. But for those who might be your first time investing in private equity, or you never have before, or are familiar with it, essentially, oftentimes when you invest in private equity or venture capital funds, you end up basically locking up your money for 5-10 years. It's a very, very different experience than investing in public equities where you can take your money out whenever you want. And that has some obvious downsides, right? In terms of, it's one of the reasons we mentioned earlier for why people choose to invest into why institutions only put 15%, say, into private equity, despite the fact that it's historically performed quite well. But also that illiquidity in many ways is important. It's you get what's called an illiquidity premium. From like a very academic standpoint, it's part of the reason why these funds are expected to perform higher than the S&P. And in many ways, if you are not, in many ways, if you have money that you don't need for 10, 15 years, and you're not getting an illiquidity premium for it by investing it into something that's illiquid, in many ways, you're kind of leaving returns on the table. Let's see. Oh, and I saw, I saw that you raised your hand. Any questions, feel free to drop them, by the way. This is for everyone in the Q&A. And we'll knock those out as we see those come through. So feel free, anyone at any time, to drop a question in there, and we can hop around and keep it pretty conversational. One thing though that I thought was really interesting, this is some data from McKinsey, which covers how investors who think institutionally invest across the private markets. I thought this was really, really interesting. Basically, what we're seeing is that 34% of allocation is going into kind of traditional buyout private equity. So people doing, takeovers and things like that. You have 18% to venture capital, another kind of subset of private equity. And then you have 8.4% into growth equity. So over half of the AUM when institutional investors are thinking about alternatives is going into private equity in some way, whether it's in buyout, growth, or venture. And so what's also been interesting is this private debt sliver over here. This has really been growing in popularity in the last few years. I think a lot of this is because of debt's perceived, right or wrong, perceived stability compared to equities. And it definitely plays a place in a portfolio. Miguel, I'm really curious your opinion on this as you think about broader allocations. One thing that me and my co-founder have talked a lot is that, we like to, oftentimes, at least personally, I like to zig when other people zag. And seeing these like massive inflows of capital going into private debt, it worries me the same way, 5 years ago, there were massive inflows of capital to venture, right? And, it's once you get out of that first tranche in private debt, things can start to get a little very risky. But obviously has a place in kind of everybody's portfolio. But I don't know if you spent any time thinking about that with any of your clients.
Yeah, I mean, I talked a little bit about it before, right? How post 2008 through 2021 in particular, we saw growth equity doing insane. We saw capital flowing like crazy to private equity VC. We saw valuations, especially anything tech in that world, exploding in value. And around 2020, I think 2019, I got into a little tiff with a VC guy. Off the back of some of the more sensational blowups, the WeWorks of the world, et cetera. And I was like, it's getting a little hot in here. Like it's getting a little euphoric. It's getting a little over, I want to zig when people zag. And so we saw that in 2022. That's why I wanted to ask you a little bit, about how does this data look looking at it, say like 2015 to 2020, right? Like, is this data very different? Because 2022 was a huge sort of repricing for this space, right? Especially in our space in fintech, if I'm not mistaken. It was one of the most harshly repriced situations. And, of course, I decided to start a company now, right? Zigging while zagging. I wonder what the space feels like the people who are closer to this, what do you think? Do you think it's a good time to be looking at PEVC with all of that, trauma from last year, or are we more cautious, and maybe it makes more sense to go into private debt? If you ask me, we have an entire industry of professionals, you and me included, who have not really operated in a rising rates environment, right? So you have all this capital flowing to private debt, but who's been doing this for the last 20 years? So as we saw interest rates creep up to 5%, I started, just kind of in conversations with colleagues and clients and stuff. I was like, once rates go above 5%, some things are gonna start to break. The things that shouldn't, be functioning are gonna start to break. And so that's my concern with private credit. Um, as well. I don't know if we're there yet. I don't think so. And these managers are talented. They probably were operating in private credit at a hedge fund or a private debt fund for those years, and especially outside the U.S. There were some interesting things going on, even especially in 2022. If you look at Brazil, there were some good opportunities there with carry and whatever, but yeah, the private debt thing kind of gives me a little bit of that same feeling. Like people are maybe over flowing capital to private credit, but we'll see. That said, I think a lot of institutional investors are very happy to see rates where they are. Like, okay, I can offload tranches of my portfolio from potential sources of risk and let it cruise in treasuries and just get my risk-free rate. And then it also makes things more possible in private debt. And another consideration, I was talking to a friend of mine who's a trader at One William Street, and he was pounding the table talking about equity risk premium versus risk-free rate, right? And he's showing me investment grade spreads versus the risk premium in equities. And he showed me that chart, and it's kind of a no-brainer. Like there is an interesting scene popping up there, right, in fixed income because rates have gone up. There's more spreads. It's almost like back to the markets of yore that I used to hear about. I have some older friends that came up in fixed income sales and trading, right, and I kind of wonder, it's like, what have you really been up to for the last decade? Because it's been kind of a tricky environment. But now there's something. We'll see if we can kind of survive it. We'll see if the private debt space keeps the size that it accrued over the last year or so, or not. But it's definitely the cool kid in town in the alts
Yeah.
world.
I mean, one thing that's definitely happened over the past few years among that uncertainty has been a flight to quality, which has been very interesting to see.
Yeah.
Kind of in the 5 years as we're thinking through sort of like what the world of VC funds, PE funds looks like in the 5 years leading up to 2020 when we were in a massive bull market. It was relatively easy to spread your chips across the table and make a return. And we saw a lot of small VC funds pop up. One of my favorites is I run into this a lot. You guys would be shocked how often I see this, but somebody who, made a fortune in like Bitcoin or something like that, thought they were a genius investor, and then ended up launching a VC fund. And sometimes, like, they are really good investors. Sometimes they got really lucky with Bitcoin, right? And in 2015 to 2020, people were kind of making money hand over fist, and you saw a lot of small VC funds pop up. And what we're seeing is that they're having trouble raising. So this chart is kind of showing that if you take a look at 2020 to 2022, you've seen this is sort of where cash has been flowing into the PE and VC space. What funds have been raising? And what you see is that more capital is being raised by your $1 billion plus funds. In 2012, under 50% of capital was raised by funds that were $1 billion or more in size. Now it's almost 70%. And so you're seeing this flight to quality or this flight to perceived quality. A lot of these smaller funds are, your first, second time VC funds, or they're sort of your middle market PE funds that are going to be having trouble as rates rise. There's kind of three levers in the PE space through which you make money, right? You make it through leverage, you make it through financial engineering, and then you make it through organic growth. And with rates rising and multiples not rising the way they were 5 years ago, it's it's going to make it harder on some of those middle market managers, and VCs are going to be stretched for raising. That does mean though, like like the funds that do raise in that space, there can be some diamonds in the rough, right? There always can be, but I think it's just they've had some trouble in this environment for sure, and that's been reflected in terms of who these institutions are allocating to. Joe, you had a question that I just saw about. Love to kind of like take a second to answer some of the Q&A that's come through. You had a question on sort of thinking through the difference between private, dividends and cash flow versus kind of more backloaded distributions that I think are really common in private equity and venture capital. So just, for some information, when you say invest in like a dividend stock, for example, of public equities, you're going to be getting cash every single year from that, right? Ideally, assuming nothing goes wrong with the dividend. Versus private equity, you put your money in and you might start getting chunks of cash back that are lumpy, 5, 6, 7, 8 years down the line. And I think it really depends on that's a hyper personal decision, right? In terms of what you're looking for. You're with dividend stocks, you're going to have the advantage of getting cash flows on a regular basis. You're also going to have kind of the disadvantage around, paying taxes on that really frequently and being a little bit more constrained. You're not going to get a liquidity premium, but you are going to have liquidity, and you're going to be getting cash more regular intervals. I think it's a balance, right? When you invest in kind of a private equity or venture capital fund, you're ideally, knock on wood, going to be in an asset that's slightly less correlated, in an asset that historically has performed better. And then also depending on one thing that I think funds don't talk about enough, but there can also be certain tax benefits for investing in certain types of VC funds as well that you don't get in public equities. For example, qualified small business stock can be a really, really huge one. And that's really nice. We also got a question about talking more about pricing spreads on the debt side. How are you factoring beta risk when contemplating private debt opportunities? So for example, an opportunity to loan a certain amount at 10% to a company with a signed purchase agreement on working capital feels low risk, but isn't terribly exciting. I think that in many cases, that's the world of private debt, right? You're often doing financing, right? And it's not always as sexy as owning a company, but it certainly has a place in people's portfolios. I'm by no means an expert on private debt opportunities, and I would never claim to be. Over the past year, I've probably looked at 100+ different VC and PE funds, diligencing them. I've probably looked at only a handful of private debt funds. But Miguel, I don't know if you have any thoughts on that.
Yeah, no, you covered it pretty well. I mean, I've been, I've looked at a few private credit funds, but again, yeah, I haven't worked on deals on my end. But I've always sort of viewed the space as, you're getting access to sort of commercial lending, like the lender side with fewer rules and a lot more sort of idiosyncrasy, right? And they generate a premium out of entering into these idiosyncratic deals and diligencing them to the bone and coming up with their loan rate, and it's supposed to outperform the risk-free rate in a very, very controlled and very sort of well diligenced way. So in the same case as I sort of think about my private equity allocation or VC allocation, which I'm very, very much the only things I care about, right, are total return and correlation for the rest of my asset allocation. With private credit, it's kind of a similar answer, right? Like, is this thing doing what it is promising to do? With a higher level of skittishness, I would say, a lower level of like tolerance for not getting the results that we're expecting, right? It's supposed to be, a less risky asset class. Like Joe said, not terribly exciting. But yeah, that's more or less how I feel about it. I like his next question about yield codes and private leverage equity deals. Way back in the day, I worked on a couple of yield co and master limited partnership deals. which, that's getting a little bit more technical there, but I don't know if you want to get that later.
Yeah, I think the slide that I turned to, and I'll take a minute kind of to provide
Cool.
some context for folks.
Yeah.
We were chatting a bit about private debt because it's definitely been rising in popularity. This slide shows some data from McKinsey that I think really highlights nicely the different expectations among different alternative asset classes. So this is some data from McKinsey taking a look at median IRRs from 2009 to 2019, but also taking a look at manager performance, right? Just how when you invest in a stock, sometimes, it will perform differently. When you invest in a private equity fund, some will perform exceptionally, some will perform very not exceptionally, right? But what's important is when you take a look at the managers, how are people performing on the whole? What we see is that in private equity, that dark band is the top 25% of managers, or 25th percentile. And then that lightest blue is your bottom 25%, and then that middle blue is the median. And what's really interesting, what you see is that in this time period that McKinsey looked at, private equity across the board performed better than other alternative asset classes, and that's part of the reason why we've liked it so much historically, right? The top 25% performed better than the top 25% of any of the other four that were looked at. And the bottom 25% performed better than the bottom 25% of any of the other four that were looked at. What was also interesting, though, is that private equity had the highest spread, right? So on average, in that time period, you got the highest returns investing in private equity, but you also had the most variability, right? Whereas private debt had some of the lowest returns, but it had the smallest spread out of any of the five alternative asset classes looked at here. We got a question in the Q&A about what about kind of private equity like deals that are in maybe more infrastructure focused projects like individual solar farms. Bridges could be another one that, or utilities and things like that. A lot of times I'd almost think about those as, it's interesting. Some people group those in with private equity, and they are certainly private equity type deals. Other people kind of group them into this fifth bucket over here under infrastructure, and infrastructure type deals, because oftentimes they have a very different return profile than your traditional private equity, and they are kind of distributing cash flows regularly, which can be quite nice. But also the fact that they are more predictable is naturally going to push down returns. So on infrastructure over here, it had a fairly decent spread, but also a 9.3 average IRR in the median. So still performed fairly well, I think, in line with the S&P. But I just think that this is a really fantastic slide. I think it really shows, at least over that 10-year period, what people have got from investing in these different asset classes. And I think highlights a lot of the appeal that we talked about on the first slide, right? Like why these institutions are allocating so much into these areas.
Yeah, my takeaway from that previous slide is keep it simple.
Yeah.
Yeah, so I wanted to pop out this slide. It does a decent job of reiterating probably that second slide that showed what assets have outperformed or generated excess returns over time, and comparing equities versus alts. This is showing like the whole portfolio. So these are different portfolio mixes, different portfolio blends. We have a 40 equity, 30 bonds, 30 alts over there above 8%. And this illustrates that era that I explained, that we talked about at the beginning, right? Where we had zero interest rates, and a lot of investors that were in a 60-40 portfolio, 60% equity, 40 bonds, have kind of pivoted into this 40-30-30, which generates a similar risk return profile, but with more upside. I mean, you have that private equity piece, you have that public equity piece, and a smaller fixed income piece. So you're giving yourself the same risk profile with much higher potential upside. And I like that portfolio a lot for individuals as well, right? Because it's something that wasn't necessarily possible until recently. But this is a great example of just showing different portfolio mixes over time and how they behave. This is from JP Morgan, their Guide to the Markets, which is a great resource.
Yeah, this
Yeah,
is
and so
super similar, I think, to the. Sorry, Miguel, go for it.
no, it's just wrapping up. Just basically, I think we're in sort of a new era as far as asset allocation, what's accessible and what's possible, and also what has the institutional investor world gone more accustomed to. So I love this slide. It gives people a little bit of a visualization of what they can expect if they integrate alts into their longer term plan. Yeah.
Yeah, with that, guys, we have a few more minutes. A couple of Q&A questions have come in since then, and we'll reserve kind of 5 or 10 minutes at the end to answer any questions. So if you guys have any questions you'd like to ask, drop them in. But I'd love to just maybe ask, we have a few minutes left. I just launched a quick poll, so feel free to answer. But we'd love to know, is there anything that we'd like to double click on with kind of the few minutes that we have left, whether it's interest and inflation, the different types of private equity in the market, whether it's buyout, growth, venture, et cetera, impact funds and ESG, operating teams, asset correlation, manager selection, et cetera. I'll give it a couple minutes if there's anything else so that people can answer. But feel free to click anything that you guys would like to touch on.
I can't vote, John. I can't vote. Panelists can't vote. Oh.
Miguel, what would you like to talk about?
I don't know if this has ever happened to you, but I had a chart escape me. I saw this great, very simple chart that just basically shows the different asset classes that we've discussed, like on a perpendicular, or like on a right side up standard distribution curve of what the return profile looks like. And so it goes like public equities, private equity, private credit, and shows you like what are the upper and lower bounds of what you can expect. And yeah, so I'm curious to hear a little bit more about what you think about the different types of alternatives, predominantly on the equity side. So like PE, VC going forward, like across the next year. Any sort of sentiment given like the inflation and interest rate backdrop and maybe the repricing that happened last year. Just curious for your sort of gut take on what the next year or so looks like for PE and VC in particular.
No, that also seems to be kind of the two top interest areas, or interest in inflation, and then types of private equity assets. So why don't we dive in on those? I have some good slides in the back that I think will be helpful for discussing that. Give me 1 second. But yeah, it's a good question, and I often get kind of tied up in talking about private equity so much. I forget to kind of double click on what are the different types of private equity opportunities. And I personally believe it's important to be exposed to all the different types of private equity asset classes. We talked about before, there's the huge benefits of diversification, right? And so that chart, diversification just it increases your risk adjusted returns, which is what we're seeking what everybody's seeking in investing, right? And it is from like many academics, I think would argue it is the only or the best ways through diversification. And so I think that applies just as much to private equity. Your private equity portfolio should be diversified as well. How it's diversified is a really personal question, but it's super important. And so when we talk about private equity, there's really three different buckets that we're talking about. So on the super early stage side, you have venture capital. Venture capital is people going out, taking equity stakes in companies, generally at the very, very, very early stage. And so it's they could be pre-product. They might have a product, but they're pre-revenue, or maybe they have revenue, but they're thinking about how to scale it. And venture capitalists will go out, make generally quite risky investments, but on the hope that they will, 10x, 50x, 100x their investment. And so venture capitalists will go out and maybe take, they might take as many as 100 investments across 100 different companies, um, and 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 hope that they get a few that go up 10, 50x, and that sort of makes their whole portfolio. So they're investing very early on in a company's life cycle. On the opposite side of the private equity spectrum, you have buyout, and in many ways, buyout has actually become synonymous with the term private equity. A lot of times, when people say private equity, what they're actually talking about is buyout. But buyout private equity is if venture capital is doing very, very early stage investments, buyout private equity is doing very, very, very late stage investments. So late that oftentimes they are taking companies private. So they're taking companies on the public market, and they are buying all their shares, taking them private, because they think that there's a mismatch in terms of how they're valued. But it's typically quite late stage. Company is not growing super quickly. They might be growing, they might not be growing, but they're not in that very early stage of a company's life cycle. They'll often employ leverage in those deals. Obviously, that's getting harder in the rising interest and inflationary environment that we're in right now, and we kind of talk about that. We can kind of talk about that next. But that's buyout. When you think of private equity, like top dog private equity funds, when you think about Blackstone, TPG, KKR, Cerberus, Apollo, those are typically operating buyout funds. And then on the right-hand side, you have growth. And growth is this really interesting space. I used to work at a growth equity fund before starting OneFund called General Atlantic. But growth equity operates this interesting space in between venture capital and buyout. And so venture capitalists, if they're interested in taking super early bets on companies that they have high conviction in, and if buyout is interested in investing in really late stage, stable companies, say like manufacturers, things like that, growth comes in this period in between, where the companies may be too big for a venture, it's found product market fit, but it's too early for growth. It's not too early for buyout. It's not mature enough, but it's still growing very quickly. Growth will come in and often take minority investments, meaning they're buying less than 50% of the company. They don't control the company, but they're injecting cash into a business that is already operating really well, on the hopes that it will accelerate that growth, and they'll be able to take that company public or sell it to maybe a later stage buyout fund for a return when it does fit that profile of what a buyout fund is looking to invest in. And so those are kind of the three different types of private equity that we think of when we talk about private equity. I personally, think it's important to invest across the entire private equity life cycle for diversification purposes. It's funny, 2009 to 2019, obviously, compared to buyout and venture capital, according to this data from McKinsey, was not as good a year, not as good a time span for growth, right? But 2019, 2020, 2021 were typically very good years for growth. And so having that ability in your portfolio for them to offset each other and work together is very powerful. But what you do see here, which I think is very typical, is this spread between venture capital and buyout. Oftentimes, venture capital is perceived, and this data shows it as having higher returns historically than buyout, but significantly higher spread in returns. Whereas buyout historically has tended to be a bit more consistent in terms of the returns. And so, whereas a median venture capital fund that McKinsey looked at in this data returned 23.1% IRR from this time period, buyout fund returned 19.4%. I think where you start to see the most alpha on venture capital funds is when you start looking at the top percentile. And part of that is just because of their strategy, right? They're taking a lot of small, very risky bets. And if they manage to get just a few more of those to hit than they were expecting, the fund can perform very, very, very well. And so that's often, when you look at top percentile VC funds, they tend to perform sometimes shockingly well. On the flip side, though, when you look at bottom percentile VC funds, it's often the reverse, right? But that. Yeah, exactly. And so I think it's part of the reason why it's just very important to be careful with manager selection. When we're diligencing funds, we're going really deep on things like their past performance, on their thesis, on their predecessor funds, on their team, what their team's track record is. One thing that's really important to look at, that I look at when I'm diligencing a fund, is not just the performance of their prior investments, but also their deal attribution. You can have, these are partnerships, right? So a venture capital fund has, 5, 6, 7 people who are making deals maybe. If there were 1 or 2 partners that were making all of the top deals and they left the fund, you want to know that. And so you want to take a look not only at how their past investments have performed, but you also want to take a look at who is making those investments and are they still with the firm. There was another comment about kind of talking about interest rates and inflation. This is really interesting, and I'll try only to take up a couple minutes on this, because there were a couple questions that came through on the Q&A that I want to make sure we have time to answer for folks. But I think news just came out that the Fed, if I remember correctly from Wednesday, chose not to increase rates in this next cycle. You can kind of see historically that interest rates have been tapering off around that 5.5%. Who knows how long it will stay there? With inflation going down as much as it has, which you can see on this slide, it seems unlikely that they're going to continue to increase rates. At least that tends to be what they're signaling, as far as I can tell. But what's interesting from the strategy is just this has broken a lot of the math for a lot of your middle market buyout shops. If it's harder to borrow money, it's harder to buy assets on leverage. And so over the last 10 years, when interest rates were near zero, it was very, very easy to borrow money, lever up a deal, and use that to juice returns. And that's just going to get harder going forward, and it's harder now. Funds will adjust, right? I mean, you had 20% interest rates, 15% interest rates at certain points historically, and funds found ways to deliver alpha. But certain strategies, certain niche managers who relied on it a lot, especially in the middle market space, are probably going to face some headwinds, and they'll adjust. But another thing that this is going to do, and we saw this happen, it's going to impact tech multiples. Inflation also is going to impact tech multiples. It's interesting, as inflation has gone down, I think we've seen tech multiples start to rebound a little bit. And if we kind of mirrored it off on this, you'd see it kind of going and starting to rebound a little bit. But it definitely had some trouble. The good news is that inflation getting back down into this, call it 2.5, 3% range. Who knows if they'll be happy with that, and they might try to drop it, get inflation down lower again. Is that it's going to relieve a lot of pressure on the system. When I was at General Atlantic, I spent a lot of time thinking about pricing and how our portfolio companies price their products. And this just made things really, really, really complicated in terms of rising inflation. And so this going back down is just going to kind of, I think, degunk the system a little bit. Consumer demand, interestingly, really did not fall that much when inflation went up. And so that also, I think, it made it very difficult for the Federal Reserve, but I think it was a bit of a godsend for a lot of the funds that were relying on consumer demand here. But we're just, monitoring the situation closely, and we'll see how it continues to develop. But yeah, I do wonder about how funds that relied on leverage are going to continue to do that going forward.
Well, they have to adjust or survive, right? Like it's crazy because you see the power of interest rates across all asset classes, right? And like you saw it in the public markets in 2022, the market said, we're over growth. Like we're done with growth and we're done with momentum. We're now refocusing on which companies have staying power, so a flight to quality on the public side, and then investors changing their sought after. It changed the KPIs they were seeking within companies, right? This shift away from raw growth to a more profitable, sustainable profile. And I would imagine that those middle market, managers using leverage in the private space are having to go through that same, reflection process of, this play isn't working anymore. The environment nor the investors necessarily are so enamored with growth that they're just okay with us using leverage to push things through. Now, people are digging deeper, right? And you see it in the flight to quality in private funds. People want to know, who are these managers? What is their selection process? What's their diligence process? And I'm sure that was much, much harder for the small and medium funds to field, post 2022 and after such a big repricing. And that brings me to sort of where you started, which was manager selection, but also from the perspective of a family or an individual. How do you navigate this? Like, how do you navigate the suitability? How do you take all the considerations we discussed in this call into that investment when, let's say you're a guy at a tech company and you have most of your portfolio in public equities or in a retirement plan, and you're thinking, okay, I want to make an allocation into private. They watch this webinar and they're like, I don't know how I'm going to study managers, compare funds, do all of that, and is it worth it for this highly locked up allocation? And where people like OneFund, where these great funds really earn their keep, are in being able to take that on for the investor and sort of build that relationship of, I trust these guys, I trust their diligence process, I trust their experience in navigating these different managers and different things. And so I think that's a huge value add of what you guys are doing. You make it not only accessible but like navigable for an individual, because just diligencing the fund that's available to receive your capital is way more work than typical individuals or family are able to necessarily put in. And in these conditions, right, where we've experienced quite a bit of volatility, there's all these new tools, all these new ways to access. It just puts that emphasis on those relationships even more, and on that diligence process even more. And it's a good time. Like I said, it's an interesting time to zig while zagging, because a lot of the flack got sort of burnt off through the rising rates, through the volatility of last year. Yeah.
Yeah, and we're starting to run up on time, and I don't want to keep you guys, so we'll wrap things up. But we really appreciate you guys joining. I'm just showing this slide quickly because I think it encapsulates all of it. Right? There's folks down here who generally have not been able to get, or up here who generally have not been able to get access to PEVC. And I think a big thing of what we're trying to do because of all this data is give more folks the option to invest like the institutions if they want to. So I'll flip over to this last slide, and here's just my contact information. If you guys have any questions at all, feel free to email me. And thank you so much for joining. It was a pleasure getting to answer your guys' questions and chat a little bit about things we're passionate about. So thank you very much, everyone.
All right. Thanks, John. Thanks, everyone.